Good morning. Welcome to Friday Coffee Meetup. I'm Christy Connor, the host of Friday Coffee Meetup. We are an innovation tech entrepreneurship meetup in Los Angeles, California, sunny Los Angeles. And we have about 7,000 members. We're really focused on building the innovation community in Southern California. We have moved to virtual due to COVID, but we are so happy to have all of our members here. Although you're seeing my face right now, there's actually a whole host of people behind me that help put this on each week. And I want to show you their wonderful faces. They help us do things like set up speakers and events and our podcast channel and our YouTube channel, which is being posted in the chat window right now. So you can check that out if you've missed some of our speakers in the past. We've had maybe 5 years of different speakers who bring us new and innovative ideas each week. So check those out. We are putting some information into the chat channel. You will notice in there that the chat channel is unmoderated, but you can go ahead and chat to your friends there. We will be doing Q&A today after the presentation from the Q&A panel at the bottom center of your screen. So put your questions into the Q&A panel. That way they'll get asked. We ask you be brief in your questions. Trying to piece together a lot of different questions, and really long questions can be challenging, so please be as brief as possible. We also ask for your patience and that we might not get to all the questions today, but you still have an opportunity to possibly ask as we hold open networking after the event. So what will happen is if you want to stay on and meet some of your fellow participants and talk to some of our co-organizers, you can stay on and we will move you over into the panelist pool and you can ask some questions there as well. And that's moderated by two of our co-organizers, Wayne and Jan. So we thank them for leading us through those efforts today. In the chat window, you will also notice, if you're hiring, we would love to hear about any jobs that you are posting for. We are all about getting our members new and exciting opportunities. And then as well, I have posted some further information about Adriana Saman, who's here to talk to us today. So you can check out some of the things she's excited about and interested in there. With that, I am very excited to introduce Adriana Saman. She is with Clocktower Ventures, and she's here to speak with us about fintech trends in a post-COVID area, and specifically how COVID has affected 3 areas of fintech: payments, investment tech, and personal finance, and what these changes have actually done to affect the startup environment. And, as a founder, how is that affecting founders and venture capitalists? How are they looking at funding? We are really pleased to have Adriana here with us today. Please welcome her. I'm going to stop sharing now and turn it over to you, Adriana.
Hi, everyone. I'm Adriana. Thanks for coming and joining us today. So just to start off, thank you, Christy. I'm going to be talking about the effects of COVID in fintech, but right before jumping there, I'd love to share a little about my background and Clocktower Ventures. So from my background, I'm originally from Ecuador. I came to US for college, spent the first years of my career doing investment banking at JP Morgan. I was covering M&A transactions in Latin America. And then my last year at the bank, I actually switched internally to join a fintech team. I was doing strategy for digital payments. So I was covering all of the roadmap of the features and products that you use every day on your Chase app. After spending a year doing that, I joined Clocktower Ventures, which was almost a year and a half ago, and moved to LA to join the team. I'm part of the investment team. It's a team of 5. And just to tell a little about Clocktower, Clocktower Ventures is a fintech-focused VC. We invest early stage, so C through Series B, and we invest mostly in the US, but also we have a bunch of investments in Europe and in Latin America. We have a bit of a unique philosophy where we are very your friendly co-investor, but we never lead rounds and we never take board seats. So we're usually highly collaborative with a lot of other VCs in that also invest in fintech. So just to jump into the topic today, there's gonna be 3 verticals I'm gonna be covering: payments, personal finance, and investment tech, as Christy said. But I think I'm gonna spend most of the time on the first 2, because I think these are the ones that are mostly affected by COVID and are actually being fundamentally reshaped moving forward. And then I'm gonna touch a little bit on investment tech, on a few trends that I think are important to keep in mind, and we'll take it from there. So I'll show my screen to start off with payments. All right, so COVID, I'll show you my favorite COVID chart ever. This is it. So what are we seeing here in payments? It took 10 years for there to be a 10% increase in e-commerce penetration of retail sales. And that same percentage just happened in the span of 8 weeks whenever COVID hit and people were in quarantine, forced to take so many of the transactions online. So what are we seeing here? COVID has given extra boosts to already rapidly volume of e-commerce and general card non-present transactions, while actually simultaneously provoking a drop in cash. These are related, but they have very different effects in how we think about financial services. Payments affects, the way I think about it, there's 2 players that are affected by payments. You have merchants and you have consumers. So on the merchant side, you'll see that payments have transitioned, digital payments have transitioned from a nice to have good experience to an actual necessity to stay afloat. Whereas on the consumer front, we value more and prioritize contactless payments and just general security around the transactions when we engage in a transaction online or at a point of sale, but when it's cashless. And then generally, given the effects on liquidity that COVID has had, you see a desperate need for immediate cash, and there's a lot of important things that are happening as a result. So I will present you the way I'm thinking about these effects in 2 different frameworks. We're starting off with consumer, and then we're gonna go on the merchant side. So on the consumer side, well, and then these are 5 trends that I think are the same, but they just have different implications. So the biggest one is the surge in e-commerce, right? So in e-commerce, we have, as a consumer, I navigate a lot more online. I'm buying everything, even my groceries online, even if I used to go and pay cash everywhere I went. And what do I care about? I care a lot more about a faster checkout speed, a better experience, and I'm also much more conscious about fraud and chargebacks and my card not going through, and I'm gonna drop out very easy and look for the next merchant that will take it immediately. And this not only increases the volume of the amount of people who use Stripe and PayPal, but it also leads to a surge in services that are adjacent to these services, which I think is very important. This is the rise of startups that we're seeing now, and a lot of what we see are looking at, right? So companies that enable fast checkout, like Fast.co, or passwordless authentication, biometric authentication, and cybersecurity, like private keys, predicting the intent of a transaction, right? So making sure before a transaction happens that there's no fraud. These are just a few examples in general. I'm just seeing a few examples of the world of trends that we're seeing that are rising as a result. And then the drop in cash also has different implications, right? If you would pay your mom or your friends in cash, you're no longer doing that. Not only because you can't see them in person, but also because of an awareness of contagion, right? And what are implications? If you were too wary to use your Zelle account, or if you had not downloaded Venmo, this is the time you're doing that. And more importantly, you're finally engaging in contactless payments, right? So I don't see a lot of new entrants in this space, but I do see much higher engagement in these virtual apps that have taken such a long time to change the habit around, especially Apple Pay and Google Pay. then there's a drop. I mean, branchless are effectively useless at this point, right? At the moment, you can't go and do anything physical. You can't go to your regional bank and open an account with your banker. You can't pay with a check. You can't go and like pay a bill, or you can mail it, but it's going to take longer. And so on this side, actually, just a rise in online account opening and servicing, and apps that allow you to digitize paper processes are going to be a lot more popular than before. I'm including some examples here where I actually make the case that incumbent banks are well positioned here through their apps to provide these services. The infrastructure is top notch actually, and there's no need for a challenger once you have those accounts, but now you will engage a lot more with these accounts, and that presents a lot of opportunities for them to cross-sell you on other services, or just take advantage of you becoming suddenly a power user. If you had never set up your Chase online, you will do it this time. But it also poses a super interesting opportunity for challenger banks to add new customers, because historically, well, before you had the option of going to a branch or doing it online, now you don't have the option, right? So it's perfect for challengers like Chime and MoneyLion to start acquiring more customers. And then I'm presenting someone like Papaya, which is take a picture and pay your bill, which by the way, you should download. It's very useful. And a lot of services that are just taking care of absolutely killing the need to use paper to take care of bills and checks. And then there's a need for instant liquidity that's going up. What does that mean? I mean, on the lending front, it's very clear. A lot of people are in the need to pay recurring expenses and do not have necessarily the same revenue that they've always had. So while that's embedded in lending, there's a real need for that money, for that cash out to come real time to your account, or to come as quickly as you can, without mistakes and without any, and like in a frictionless way, right? So we see a surge in the use of point of sale lending embedded in checkout services, instant access to cash advances, and real-time payments in general. I'll touch on the infrastructure around this on the merchant side, but for the consumer, I think this is prime time for these micro lenders to make sure they capture as many customers. And as I will touch in the personal finance front, I think something to watch out for here is the ability to underwrite properly who you're lending to, how much you're lending, because this is also an opportunity where you can also see way higher default ratios than usual, given that the need and the adverse selection for these loans is very different than before COVID. And then given all of these four trends that effectively mean digitization of payments, there's just a much higher use of transaction data, either to lend better, or just to understand your customer better, right? And I think this is extremely important, like moving forward, given that we're gonna have such a bigger pool of digital payments, these middle layers of abstraction of transaction data are gonna be fundamental for not only lenders, but also for merchants who want to understand their customers better, and want to target people with marketing better and use alternative sources rather than the more historical ones like Amex databases. So the ones that we see in this world are Dodge Drop, which are passive cashback services that are linked to your credit card and just tell you how much money, like how many rewards you're making. And then you have Square here, which it's more on the merchant cashless side of things, but I think this is a very unique company in the sense that they're doing an amazing job with data analytics at the point of sale. And so maybe Square owns it end to end, but I think there can be a lot more companies that provide this level of analytics to other payment facilitators or companies that process a payment, but not necessarily have that degree of granularity when they process a payment. And then I just put this company Rotomer, which I think is interesting. It's very, very early, and it's also an indication of the things that we're starting to see rise. They are abstracting transaction data all the way down to itemized item, the itemized receipts in anything that you buy. And so it's just the granularity that we're going to get now. It's unprecedented, and it's going to become a necessity to provide the quality of services that you can. Then moving on to the merchant side, it's the same 5 trends, but they affect merchants differently, right? And I think it's interesting. So, for example, the rise in e-commerce just means a higher demand for higher quality gateways, but also the fee that you pay for each payment, it's your margin a lot more than it used to, given that that's your only source of revenue, right? So merchants are going to be much more aware of how much they're paying per digital transaction, and might look for alternatives that are not the classic Stripe that they've always been using. But if they're big enough, they might become their own pay facilitator, like with a company like Phoenix, or they might replace certain pieces of the payments chain with a middle layer like Weaver, where they save, in a few words, they just save money per transaction. This becomes a lot more important than before. The drop in cash implies that merchants need to have the infrastructure for contactless payments. They need to upgrade their point of sale hardware. Like, you can no longer afford to not take Apple Pay NFS tapping payment capabilities. But then if you push it forward, I think a lot of merchants and grocery stores are now going to look more like the Amazon Go store, where you enter and grab something and you leave and it's paid for. There's infrastructure provided for merchants to build this to license these capabilities. An example is Grabango. And then we're going to see a rise of contextual payments, right? So Alexa, buy this for me, and IoT being a source of transactions. And there's going to be companies that facilitate this end-to-end, right? From the order to the authentication and to processing of the transaction. So an example here is BlueTag. They actually facilitate payments to Alexa. So I also see, and then Square, I put it here because it's point of sale hardware. So other companies are also doing point of sale. Like, this is a trend that I'm seeing here. This is actually a trend that we wouldn't invest in Clocktower because it has a hardware component by definition. But if you even push it a little further, I just don't discard a future where you go and pay with your eyes, right? So everything that's biometric, everything that's contactless, that's frictionless, there's a massive rise in that infrastructure to create those experiences. They're not only necessary, but also increasingly expected. Then the drop in branches and physical processing transactions, it's very similar to the consumer front, but it takes you a layer deeper where, okay, you no longer have 10 people manually processing your invoices and sending out invoices and paying your bills. So you start relying on services like Bill.com or ChargeBee, where you automatically generate your invoices or you automatically pay them online. And that not only gets rid of the friction of processing the paper and the time and cost that it takes, the human hours that it takes to do it, but it also engages merchants in a second layer of software services, which is understanding better the information behind those bills. Like, why am I spending so much in this? You can now start to visualize it in more insightful ways, and you can leverage that information to make better CFO decisions than before. That all lies in how you pay. It tells you your cash flow in a much digestible way than just sending papers and keeping track by hand. Then on the need for instant liquidity on the merchant side, what I think is interesting is, again, the need to get it immediately and the ability that payment facilitators have to do this better than everyone else because they have so much information on the payment flow. And so again, Square Capital, it's their SMB lending branch. They're just so good at it because they already have the distribution. They're in front of all the merchants, they're their clients, and they know exactly how much money they're transacting and times of day and everything, so they can underwrite much easily. But then there's other challengers like Jerry's, that are doing the same thing in a white label fashion. So they're enabling other payment facilitators to provide similar services to Square. And I think there's going to be a rise in these kinds of startups as well. And then use of transaction data, very similar to the consumer, but also aligned with what I just said around the drop in physical branches and the ability to understand your invoices. Credit cards for expense management like Brex and Mercury can create a similar experience where you can optimize the data around your spending to make better decisions. But then also the interesting here is around how you can use data to make payments go faster without, like, why is a payment so slow, for example, in ACH? Because it takes 3 days for a transaction to be cleared, for the funds to be verified. And whenever there's a mistake, the cost of a failed transaction is so high that it actually like hurts the business every time they accidentally pull from an account that didn't have the funds. And so there's ways to solve this with data. And so we're seeing a rise in companies that are purely using data to predict availability of funds and in general the ability of the funds to go through, and they can make the ACH process effectively feel faster. So these are, for example, Openly, Paraffin, and again, these are all seed stage companies, which just tells you this is only the beginning of a lot of the rise of faster payments that we're going to see leveraging data and predictive analytics. So these are my takeaways on payments. And most importantly, payments are popping. We're seeing way more payment startups than before. It's very notable. And I argue that the existing infrastructure is not going anywhere. We're starting actually to see more ideas to enhance infrastructure we have, the existing credit card networks, existing ACH networks, and it's just not that broken. You can just make it better effectively. And then huge opportunity now because consumer habits are accelerating their change faster than ever before. And once you start tapping with Apple Pay, you never go back, right? So it's that kind of experience, that kind of habit that lends itself to a way of innovation. And then in general, food for thought is to think about how much a surprising amount of fintech boils down to monetization of payments. And so I'll talk about this a little more when we talk about personal finance. But even at the challenger bank levels and the lending levels, e-commerce, a lot of the money that's made comes from the actual transaction, from monetizing the transaction. Obviously, not just the money that goes through. And so digitizing this allows a lot of players to make more money with each transaction, and other forces other players to optimize how much money they lose in each transaction. So moving on to personal finance. This is a chart that I picked to start off with personal finance, unemployment rate. And I picked this because this phenomenon is caused by the COVID crisis, but it also drives a lot of the fintech needs that have risen thanks to COVID. And COVID has put a lot of people in a vulnerable position, and the effects can be categorized from 2 lenses, which I'm going to show you in my framework. The middle class and the mass affluent have been affected very differently in this crisis, and their fintech needs and financial services requirements have evolved accordingly. So there's an interesting thing here, for example. The way I'm thinking about this, I picked the 4 most important journeys of your personal finance, which is saving, spending, investing, and borrowing money, and how it has affected each class. So savings, for the middle class, savings are drastically lower because they probably lost a job, got furloughed. There's a higher likelihood than the mass affluent, but their spending stays the same, mostly because a lot of the spending is day-to-day necessities and not just for entertainment or in addition to what you normally would spend. And so on the savings front, what are we seeing? And much higher engagement or need, or finally a desire to look for fintech apps that can help you reduce your monthly bills or reduce recurring payments and save money in ways that you wouldn't have been normally carrying to save money on. For example, Trim negotiates your bills for you and tries to lower them and keeps a percentage of your discount. And Proper files a claim to revalue your property and helps you save money on property taxes. You have Matic Insurance, site comparison for home insurance. Again, these are all examples of a rise of companies. We've had this for a while. These are not coming as a result of COVID, but these are getting much higher engagement thanks to COVID, and are just proving to be truly useful and like game changing to a lot of people at this point. On the mass affluent side, for savings are going up because their spending budget is now, they are spending way less on their credit cards, but they're actually, so where does that money go? That money is either saved more or invested. So on the savings side, I put Marcos, and I'm just thinking generally about a high yield savings account, which right now is not as incentivized as it used to be, but it's generally where you should expect the flow of money to go because they're savvy enough to understand the difference. Then on the spending front, I think it's very interesting. The middle class, it's pretty stable. And so what does that mean? It means that Chime, Current, Moneyline, or the challenger banks are still benefiting from interchange transactions. So as I was saying before, the payment process represents a lot of revenue for these players, and they're still making money there. They are not they're not necessarily making a lot of more money on the lead gen front, which is usually a lot of their sources of revenue, but they're keeping engagement as high as usual, and they're thriving and engaging more people. On the other hand, mass affluent spending is down, which just doesn't mean much at this point in terms of financial services engagement. And then on the investing side, if there was ever a budget for investing on the middle class, it would probably be allocated to just making sure that you can use it to cover your normal expenses. Whereas in mass affluent, you get an actual rise in investment. And I'll touch on this a little investment tech, but mostly here, it's the volatility that COVID caused in the markets made investing in stocks just that much more entertaining for people with a disposable income to do it. And so this is where you get the Robinhood craze notion of new traders coming to the market and just adding money to stocks that are without truly thinking through the implications. It's just more about the thrill of placing a bet, and you can see the volumes have been through the roof in trading, right? But then you also get more sophisticated investors using apps such as M1 Finance and the traditional brokers, much more engaged in trying to buy, I guess, the dip in a more thoughtful way if you can, or just generally adding more money to your investment accounts. So the rise in trading, I think it's super important. And then on the borrowing front, it's very different across classes. So for the middle class, you get a stronger need for payday loans, like I was saying, also in payments. Like payments makes it immediate, but in the personal finance world, it just means much higher engagement in these apps. And I don't know if there's going to be a rise in new companies doing this, but I do argue that there's an extreme need to have this underwriting system be in place in a much more efficient way than before, because there's real risk for default ratios to be higher. But on the other hand, for a mass affluent, I wouldn't say that borrowing necessarily goes up, but rates are so low that there's real incentives to refinance your mortgage or to take advantage to borrow from an investment perspective to buy something else, not necessarily to pay for things that you cannot pay on your day-to-day. And so companies like Better, like neo mortgage lenders, neo-auto lenders are going to see a rise in engagement, and there's probably going to be even more companies coming on this front. And again, this speaks to the whole digitization. It's all related, right? Because you have more people online, you can also benefit from that and like optimize distribution channels to not only lend better with more technology, but also just reach more people at the same time. And then there's this fifth factor that I think it's just very interesting, that it's irrespective of your socioeconomic status. It's the amount of time you spend at home, right? Everyone's spending more time at home. And so spending more time at home makes it within the context of your cash flow just drastically changing in either side of the spectrum. You're just thinking more about your finances and you have more time to think about it. So rising use of budgeting apps like Albert. And then one of my favorite examples is Tomorrow. It's a life insurance company that uses as a distribution channel the ability for you to create your own will and have it valid, and then they have you think about life insurance and the people that you care about, and that's how they sell you into life insurance. And so, sorry, I just saw a question, got distracted. Sorry, go back. And so they have seen, as a matter of fact, a spike in enrollment in insurance. And it's not only because people are at home thinking about, like, they have now time to create their will, but also people have been more aware of the importance of life insurance and the likelihood of dying. Unfortunately, it's true. And so there's just a lot of adjacent services that come out as a result of the psychological effects that you get of what's happening in COVID. And you can sell great services that make people's lives better in a more efficient way, and just force people to think about things that you normally don't think in your day-to-day. And then I put steady here too, because I think it's important to flag the amount of freelancing that is rising and will continue to rise as people get furloughed from their day-to-day jobs and look for alternative ways to spend less time at home and make some more money. And so there's multiple platforms like Steady where you can find out alternative ways to other gigs than the ones that you're used to doing, and then also unify your cash flow to use it better and to understand your income across all these platforms in a more efficient way. So I think, I also know, as a matter of fact, that engagement in Steady has been through the roof, and I would not be surprised that's the case in their competitive landscape. And that also it's opportunity for not only apps that help freelancers find jobs come up, but also within the personal finance side, a lot more services, financial services dedicated to freelancers. So, and this is a whole other universe, but saving more money, figure out your taxes, etc. Christy, I see you. And so these are, so mainly takeaways. It's, I think, well, as a matter of fact, Fintech has been a fundamental enabler of financial stability and access for everyone in COVID times. There's a heightened awareness of the need to budget and how useful these tools can be for you. And the need for instant liquidity is just not going away anytime soon. I think I'm running out of time. I'll just go quickly over investment tech, which is just 2 slides. And I picked this chart because I think it's it just flags 2 of the most important things that I think are happening in investment tech. First, the market volatility, and it's crazy. You can see it here, and that's what I just talked to the Robinhood craze. So I'm not going to elaborate further. But then on the institutional side, it has also been extremely important for banks in terms of the amount of money they've made and counteracting where they've lost it. But then also, I just think it's interesting to flag that Bitcoin is still to be proven. It's indeed correlated to S&P, and it's not a safe haven yet, or a totally alternate asset classes as it was expected to be. I think this kind of event makes you think about it, and just food for thought. I'm not going to elaborate on Bitcoin. And then just to close, one final trend that I think it's important to flag for capital markets and investment tech is how COVID unpredictability turned alternative data into a necessity. It used to be a nice to have for hedge funds and trading institutional traders to make better trades, but now we're living in such unpredictable times that data signals and this sophisticated way to process them is just instrumental to make investment decisions. And so I expect a rise. Well, there's been a lot already, but even more, and just even more specific, granular data providers and alternative data sources to come up. So thank you. I think
thank you.
And
it was great to hear from you.
Great.
And we're excited to ask some questions. Can you talk a little bit about your experience of, becoming a venture capitalist?
Yes, of course. So it's a bit of an untraditional path, I guess. Well, it's not so untraditional, but so fintech, to me, VC, it's not just VC, it's like fintech VC. That's what I'm passionate about. And so why is that? I've always been very, very passionate about financial inclusion since I was in high school in Ecuador, basically, and always tried to find ways to work in a place where I could feel I could make a difference on that front, but also be engaged and love my job. And so when I started my career in investment banking, I realized that that was just not the case. And I really wanted to join a startup, have a tech exposure, and understand how that world worked. And so that's why I transitioned to the payments team. Quickly realized that I didn't quite want to be a product manager, and that I truly love interacting with people, with a lot of people at the same time, thinking about new ideas, and just the general excitement that comes with the fulfillment that comes from making an investment in someone that you think is going to make a difference. And so thinking more about that and all the challengers that we were looking out for at Chase, I was like, oh, who's financing these people? Like, that's where I want to be. And that's how it came out with, oh, I want to be venture capital. And shortly after that, I actually received, I was put in touch with Clocktower, and the rest is history. And it's been extremely fun so far. I love it.
That's amazing. Can you talk about kind of your experience as a woman? And I know that you support other women through your Synergist network. Can you talk a little bit about that?
Yes. So I've had all sorts of experiences as a woman in finance, but I think the most vital thing that I found throughout my 3 jobs is the importance to have a network and a support system where you can just go and ask for help without any remorse or without any fear that it will have an adverse effect in your career. And so I'm pretty sure I'm here where I am because of a lot of people who have helped me, and not only women, but I think when you're a woman, you talk to a woman, it's just a completely different conversation in many ways. And so I've always tried to find ways to continue giving back and helping other women achieve what they want. And so, yeah, Synergist, I started the LA chapter of Synergist, which is an organization that has 3 other chapters in the United States. We have one in New York, one in San Francisco, and one in Boston. And it's a group for non-partner women in buy side, ranging from venture capital all the way to buyout private equity. We help each other with advice. We leverage the network to get in front of very senior people and learn from them. But then we also, a lot of what we do is we help women who are in the previous spot, like in investment banking or consulting, to make the jump to the buy side. And so we're trying to do this bottoms-up grassroots movement to get more women from the get-go in the buy side, and not only get them there, but then provide them the support that they need to continue to succeed in their careers. And it's been super fun, and selfishly I've made a lot of friends as a result, so I really love it.
That's fantastic. Our next question is there any evidence that democratization of payments, for example, Bitcoin, et cetera, will result in moving this transaction all the way back to the merchant and buyer, eliminating the traditional banking role as these payment systems become more inexpensive and compact down?
I'm gonna just read it here so that I can.
Yeah.
It's a little long. Result in moving the transaction all the way back to merchant environment, the traditional banking role. So
I think they mean like, yeah, I'll let you go ahead, sorry.
So I'm not sure, I don't think the banking role will ever, okay, I don't know if I'm interpreting the question correctly, but like, I don't think the banking role is going away anytime soon. I think actually my opposing view is that banks can eventually circumvent intermediaries and you can optimize bank-to-bank relationships like sale, and like the clearing can be faster and money can move faster from banks to banks. I'm just not that bullish in completely alternative routes of payment and like people using Bitcoin for everything anytime soon, because as I said briefly, the system is just not that inefficient. Like there's some ways you can make it better, you can make it more secure, but it will have to be cheaper. Interchange is a luxury. To charge 3% per transaction, that will be lower, and that's what I'm saying about this whole on-ramps. Enhancements of the existing rails will make payments cheaper, faster, more efficient, but we'll leverage the existing networks. Like I'm even more bullish on the thesis where Square becomes its own network or Plaid becomes its own network, because of the amount of connectivity that they already have across so many players, that they can leverage a flow of information and operate at some point independently. But at the Bitcoin DeFi, I have a harder time thinking about it on the consumer front. I think maybe on the B2B side, you can argue for that. But I just think it's going to take longer than people think for that to be widespread. Just think about how long it's taken people to pay contactless. Like habits take a time to change, and it's something we need to keep in mind. It's very hard to just rewire yourself on how you're paying, and unless it's really hurting you, like it's almost like why fix it if it's not broken. So I try to think of this as more of like payment enhancements rather than replacement of the existing system.
Got it. And can you talk, or do you have an idea about a rough percentage of revenue that these companies are getting from harvesting data based on product purchase trends?
I would like to understand like which kinds of companies. I mean, there's companies that purely make money selling data, and I think I think it's hard to give you a number, like a percentage for revenue, for example, on a lender, because I think that just translates in more efficient underwriting, and it's more of a cost saving rather than a top line increase. And then on the marketing side, it's optimizing your cost of acquisition. It's just being much more efficient when you reach out to people. And so I think a lot of that is actually cost saving. And then the revenue increase would be from cheaper abilities to market more efficiently. But it's hard to give you a percentage because it's extremely contingent to the kind of business that you're talking about when they use data.
As we move to this cashless society that you highlighted the trends in, how do we think about privacy for these transactions in our transactional life?
That's a great question. I think it's a compromise that you have to take. I don't think you'll ever get true privacy in your payment information because you're leveraging third parties for the entire thing. I'd be more concerned about privacy on everything else that lies within your phone and within your house, and the connectivity of IoT and the apps that you use to engage. But on the pure number financial side, I just think it's very hard to make a point for privacy, given that the whole thing is a ledger that lies in a system that's not yours. And so it's very difficult to not be exposed in that sense. But I do think there's a massive push on online transactions to protect your other information, like your name, your last name, and all the stuff that you enter in the website. That's exactly a lot of what you're seeing as the adjacent services that I was telling you to enhance e-commerce transaction. It's a massive concern, and merchants want to make sure that people feel comfortable paying their sites, that it doesn't feel sketchy, that you don't get scammed as a result. And so it's huge. It's huge. Privacy is huge. And I think it's not privacy, it's specifically cybersecurity and enhanced authentication and fraud prevention. I think that's how you call privacy in payments. I just think privacy is a very broad term that has much stronger implications. Well, no, not much stronger, but like different implications in every different aspect of tech in general.
Have you seen any trends around, underbanked people who are going now in COVID, right? They have this need for online, but they might not have access to online. Have you seen any trends around that?
Who have needs to online that who have no, you mean people who maybe don't have like a smartphone?
Maybe people who are underbanked, like they don't have access to like a banking account or online access. Have you seen anything that's been interesting around
I think
that kind of experience?
Yeah, so there's many reasons to be unbanked. Maybe it's lack of awareness, maybe it's lack of access, right? And so the lack of awareness piece, maybe you can't fix with COVID because that's a fundamental problem, but the lack of access is basically, yes, there's like, for sure, fintech is changing that drastically. Like now you can go on Chime and just, and the interesting thing is that at Chime, and I talk about it so much because the reason why they got in front of so many unbanked people was because their whole pitch was, open a bank account, we'll give you your paycheck 2 days earlier than everyone else. And so that's immediately attracting the demographic that truly values getting your paycheck 2 days before. And now understands that if they have a checking account and they get deposited and they get this benefit, why not? And it's free to enroll and it takes 2 minutes and they verify you very quickly. And so these are exactly the kinds of plays that are getting a particular boost right now. And they're providing the perks that this demographic is craving for. And so, yes, it's a massive trend and it's irreversible. And I think it's fundamentally good for society in that specific regard, because now people are going to be banked and you have your bank account, you're going to keep using it.
Great. And as we wrap up, has the conversation, is there anything else that you want to add or talk to us about before we wrap up?
I think I'm good for now.
Okay. Well, thank you so much. That was really cool to see all of that analysis presented to us in such a concise and impactful way. Thank you for sharing that with us.
Thank you.
We are going, yeah, you're welcome. Thank you. We are going to have you guys, if you want to stay on for open networking, we are going to do that in just a minute after I turn off the recording. So feel free to stick around for that. We are also looking forward next week to Sandeep, Kira talking about kind of how to lead yourself as a leader and leadership. So we look forward to seeing you next week. Thank you so much, Adriana. We really appreciate having you here.
Okay, thank you. No, it's been so fun. Thanks for having me. I really appreciate it.
Thank you. Okay, take care, everybody. Have a great weekend.